Hi, and welcome to the Get Funded program. Thank you for being here. Today we're going to talk about debt financing versus equity financing. There are two types of financing to consider when starting a business: debt financing and equity financing. Debt financing involves borrowing a fixed sum from a lender, which is then paid back with interest. Equity financing is the sale of a percentage of a business to an investor in exchange for capital. Which one is better? Is equity financing right for your business? Equity financing is the most appropriate for high-risk technology and innovation startups, with the potential to generate a huge return on investment, as well as business in very cyclical industries that do not have a steady cash flow. Venture capitalists have demanding criteria. They typically seek to invest in companies with ambitious plans, like market domination or global reach. Investors of every type will carefully study your business plan for a strong background and management team, a demonstrated need for your product or service, a clearly defined pricing and sales strategy, preparation for completion, and realistic financial projections. Pros of equity financing. For new businesses with no revenue or those which are yet to attain profitability, equity financing can be your best, if not only, option. Investors take on almost all the risk. They receive their returns only if the business succeeds. No percentage of free revenues will be diverted to pay loans. Cons of equity financing. You give up a percentage of your business. Investors may have control over key decisions and influence the culture of the company. Landing investments can be a full-time effort, and reporting to investors regularly can take precious man-hours. Investors or equity partners usually do not expect a return on their investment for 3 to 5 years, but they often exit after 5 to 7 years. Is debt financing right for your business? Many types of small businesses benefit from the advantages of debt financing, particularly those in traditional sectors like retail, hospitality, and manufacturing. To qualify for loans and secured lines of credit, companies need to show some operating history and profitability. Before you seek debt financing, you need to have good reason to believe that you'll have enough revenue in the future to pay off the debt. Lenders typically require collateral or a personal guarantee, a business plan, good credit scores, copies of your tax returns, financial statements, and an application. Pros of debt financing. Can be used by almost any kind and size of business. You retain ownership of your business, which means you will not have to share profits long term. You know when you need to repay. There are a range of options, different kinds of loans, credit cards, lines of credits, etc. Interest on debt can be deducted from the firm's tax return. Interest rates on loans are usually lower than the return on equity investments. Cons of debt financing. Requires repayment of both principal and interest whether business is good or bad. Debt is an expense, and expenses prevent you from reinvesting your revenue in the business. There's always a risk. Defaulting will cost you the assets or personal guarantee you pledge as collateral. Lenders may restrict what you use the money for or whether you can look for more financing elsewhere. I hope after watching this video, you should be able to discern whether debt versus equity funding will most benefit your business. Click the link below if you're looking for working capital for your business. I hope you guys learned and enjoyed this video. Please don't forget to subscribe. Thank you and have a great day.